Hello, everyone. Good afternoon, and welcome to the main stage. I'm Pepe. I'm a managing partner at IOBC Capital, which is a single-family office focused on the fund of fund and direct investment in the last 3 years. We did a lot of funds investment as LP, also a lot of VC, also direct in crypto and AI. So, well, we are kicking off with a fascinating discussion on how capital formation is evolving in Web3 era. So today, our panel, Cap Table Chaos, Surviving Raising in a Hybrid World, brings together founders and investors here who are navigating the intersection of venture capitals and on-chain ownership. Let's dive in and explore more. So first of all, should we kick off the quick round of introductions? Michael, you want first?
Sure. Hey, I'm Michael Gord. I was the CEO and the founder, one of the founders of Metaverse Group. We were one of the first movers in the Metaverse. We raised $12 million and took the company public a couple years ago. We brought iconic businesses like Dolce & Gabbana, Forever 21, KPMG, Elisab, TD, et cetera, into the Metaverse. But my core business is a company called GDA Capital, or GDA Group. I'm a serial entrepreneur and investor. I've been focused on blockchain adoption for over a decade. And yeah, happy to be here.
Hi there, my name is Xiao-Xiao. I work at KKR, one of the largest private investment firms in the world with about 700 billion assets under management. I focus a lot on tech private equity in Europe, as well as leading the digital asset strategy at KKR, where we have invested into a number of top crypto VCs in the space, like Dragonfly or Powerfy, as well as leading sort of large investment rounds of later stage equity companies in the digital asset space, such as Anchorage Digital.
Mm-hmm. Cool, thank you. So the founding landscape has shifted. It's no longer just equity or tokens. What does a hybrid cap table actually mean to both of you? And how is it reshaping how projects raise and allocate ownership?
Want to start?
Yeah.
Yeah, I think to take a step back, right? Like the market we're in today, crypto VC has raised in general a lot of money in 2020, 21, and 22. Mm-hmm. Ever since, I think that the amount of total raises in VC in crypto has been declining quite drastically from that peak period. So my current estimations is like there's about totally around $70 billion of US dollars of total AUM in crypto VC. A lot of that has been raised in these previous years. In 23, there was a huge drop, probably 70% of additional money. Last year, 2024, about 10 to 15 billion of crypto VC deployed out of the capital, most of which was raised in 22. And this year, I think we're on track to a similar number, but it's still like significantly below the highs of 22. So as a founder, what does that mean, right? Like as a crypto founder, it has been, the rounds in generally have decreased in size. A lot of the, I think there's a lot more competition in the much earlier stage, pre-seed and seed stage. And that's, I think, still where, most of the competition in terms of just where most of the crypto VCs are operating. It also means that crypto VCs have to be more selective, right? And if they are building sort of conviction into a great founder or product, they like to size in more, and therefore the competition is larger. And then crypto VCs have to be more selective to survive, essentially, right? And because the crypto VCs struggle to fundraise as much as in the previous year, they have to do that. They have to be more selective. For the founders, it just means there's less total crypto VC funding available, right? And what that has led to, essentially, is that newer forms, since this year, newer forms of raising and sort of capital formation have come to the front, especially on the equity markets, right? So you have the big phenomenon this year around digital asset treasury companies, which really allows access to traditional non-crypto investors, both institutional as well as retail, to get access to some of the sort of top tokens in the space. At the same time, I think you have a lot more M&A actually going on because big companies, equity or crypto companies like Ripple or Coinbase, these are sort of have become essentially the M&A consolidators of a lot of the small companies, and they have proven sort of a viable alternative exit, right, for a crypto founder. So I think all of these added together, you have like less crypto VC, you have more sort of equity fundraisers, and you have more M&A. And I think that's sort of probably the space we are in and the time and space that we're in right now. You have more things to consider as a founder and a builder. You cannot just rely on the sort of crypto VC market to carry you through, right, all of your fundraisers. And it also means that a lot of crypto companies, as they grow up, they have to learn about equity markets, right? They have to learn about investor relations. They have to learn about the IPO process. They have to probably engage with investment bankers, and they have to, engage with equity analysts, right? These are all like very different skill sets than, if you just work in crypto native. So yeah, I think that's probably just setting the stage a little bit.
Quite a lot to unpack here. So yeah, a few initial thoughts on the capital market today versus 22, which is, I guess, when the era changed, as you were saying, and I agree with. Also interesting that we are participating at quite opposite sides of the capital market. We're playing pre-seed seed. I think you guys are Series A earliest, right?
Later.
Yeah, later. Series B. But in general, the cost of capital today is quite a bit higher. In 22, as I was saying, there was a ton of capital that went into funds in the top of the market. And that capital was deployed probably too quickly and probably largely by fund managers that did not have the same type of institutional pedigree as established Web2 VC funds. Capital moved really quickly, largely into token deals. Surprisingly, in hindsight, a lot of venture capital investors, up until 23 probably, which is when you could see who was swimming without a bathing suit, there was almost no interest in equity. Venture capitalists would only pretty much invest into tokens because of the faster possibility of liquidity, and when the market's hot, tokens are great. The challenge with tokens, I'll give you an example from my portfolio. We were first checked into a company that was growing exponentially, printing cash, and that had in their tokenomics a mandate to, well, not defined in their tokenomics to be clear, but was allocating 100% of the revenue they were generating, growing, whatever percent month over month, into buybacks of their token, which is an attractive thesis for a token holder if it was certain that they were going to, for perpetuity, continue to behave like that. But there's no certainty that they need to behave like that. And actually, it's not even necessarily the best for equity holders to have 100% of revenue go to buy back. Pros and cons. And if they change, technically, they could go from reinvesting 100% of their revenue back into tokens the next day to investing 0% of the revenue back into token holders, and the token holders have no recourse. And fortunately, the founder is trustworthy, so he has been respectful. But it's just an example of how much risk there is as a token investor in ecosystems where code is not law, and code can change, or economics can change. So I think that the challenge of a lot of founders that raise capital for tokens, owning 100% of the business with no board control or oversight, is that it provides the opportunity for founders to not be well behaved. And As a result, a lot of the funds that were deploying aggressively in 22 have struggled to return capital to their LPs. So LPs are not redeploying. And then since 23, there's been short periods of times where it's been positive to launch a token, but it has not been. There has been no liquidity in the pre-seed, seed stage, earlier part of the market. So founders have needed to find ways to actually generate revenue to, like Xiao was saying, to create a story that is actually sellable to the capital market and to equity investors, since tokens come with challenges. Yeah, I think we're pretty close to to retail coming back, liquidity coming back into the market, and then funds can return capital to their LPs, and LPs will redeploy. But yeah, founders have definitely needed to create ways to stay in business and or consolidate, which is starting to become a lot bigger of a trend.
Yeah, thank you. For us, the hybrid table simply reflects reality, because the projects today combine capital, community. Also, you mentioned DATs. We did the DATs before, like 3-4 weeks ago, and you can see, okay, let's say even the Solana, also Ethereum, like a Bitmain, whatever. So you can feel like all of those projects, they should combine with all of bankers or IPO or whatever knowledge together. And also, we more look for alignment, between those, let's say, community capital or creativity, those forces, rather than choosing one form of ownership. So this is more like a family office we're looking for, and also for you mentioned, from liquid or a listing side. So you see a lot of. I think until the end of December. So they have the pipeline with almost maybe 50 or 60 big projects are going to listing very soon. Let's say a Monad, Canton, big projects, right? So, but liquidity is not enough for this market. Where liquidity from, right? So this is a really good for next step. Okay, so for a firm like KKR, what challenge or opportunities arise when investing alongside non-traditional partners, like Metaverse players, or on the same table?
Yeah, for sure. It's a different world. Of course, for us to invest into the space. First of all, you have on the sort of fund side, of course, we're backing some of the top crypto VCs in the space, and they have a diversified LP base, of course. Institutional investors, LPs like us, as well as crypto native ones, of course. A lot of the ex-founders become LPs of some of these top funds like Dragonfly. So I think that's relatively easy because you have the LPAs govern sort of the ways, the rights and obligations that LPs have. On the direct investment side, we haven't been able to we haven't taken the step to directly invest into token projects. We've stayed sort of into what we really know well, which is equity, late stage equity. And for companies like, Anchorage Digital, which we invested in, there's a lot of crypto native investors, that have invested throughout the seed and earlier stage phases. But then when we led the last round, we of course brought a lot of co-investors from Wall Street and big institutions like Goldman Sachs and some of the other sort of big financial TradFi institutions to invest alongside us. We, of course, did the heavy lifting on the underwriting and the investment thesis and pricing the round. But I think we haven't been in a situation where we had to sort of invest into a company which both had equity as well as token. Mm-hmm. I think there's tremendous challenges still with that, right? If it's not clear where the value that a company accrues in financial terms is accrued to. Is it accrued to basically the revenue? Is it accrued to the equity, which is the normal state in TradFi? And then how is, if there is a token, what is the utility in the value accrual mechanism work? Is it only a part of the revenues, or today we're seeing a lot of projects basically using the token buyback method to kind of prove that value is being accrued to the token holders. I think the meta in crypto is shifting from sort of just infrastructure memes, I call it, like L1, L2s with sort of limited ability to create revenues and cash flows, to more of a, I would say really this year, starting to become clear there is kind of a revenue meta, right? There's more professional liquid investors looking at projects and really doing fundamental analysis on crypto projects with real cash flows and revenues. You have the pump funds of the world, Hyperliquid, of course. You have, you know, Solana, companies like Jupiter, Meteora, which are like making a lot of money. And it's for the first time, I think, in crypto, in the token side, you can actually have like comparisons of like, you can do like, you know, multiple comparisons of like how some of these DeFi projects should be valued based on their revenue, based on their growth, based on their profits. And I think that there is slowly a meta forming. You have, you know, companies like Blockworks providing token transparency frameworks. They're, you know, building dashboards. They're creating sort of standards upon which these financial metrics and accounting standards should be sort of standardized. I think this is all very helpful. And then, you know, what we of course need is basically more professional investors actually looking at these things and not just basically looking at Twitter posts and saying, being driven by sort of KOL speculation and sort of like, you know, whatever is hot, right? So I think that will be good for the space. But having said that, if some of these projects still have equity, it is not entirely clear, right? Like, because a lot of when these projects were formed, I think Pump Fund, it wasn't a private company for a long time, and they were already making a lot of financial, you know, creating a lot of financial value. And then once the tokens basically was listed, they are still the equity holders. They are now the token holders. They're using a lot of the, you know, doing buybacks. But the issue with the buybacks I have is that crypto is still in such an early stage, right? And a lot of the companies that, you know, maybe found product market fit, it's not clear how sustainable, as you mentioned, how sustainable those revenue models will be going forward. And then most of these companies are still in hyper growth phase. And if you're in hyper growth phase in TradFi, right, no professional investor on the cap table, like no VC investor, growth investor, would demand the project while it's still in growth phase to pay out 50%, or like in Hyperliquid's phase, 97% of their revenues to go back to buy back the tokens. That's essentially a dividend, right? It's like in TradFi, you only have that with super mature companies that have no growth and just have high profit margins. And then it's a way to basically like accrue value to the equity holders. It's like we pay out dividends, or like we just buy back our own shares, because there's no higher ROI activity we can use our revenues for. And I just don't think that's true in crypto, because a lot of the early stage high growth companies, although they're already making a lot of money, I think there are higher revenue, higher ROI activities like marketing, like expanding into other regions, like M&A potentially, right? To actually make the business get it to a better standing, so it can actually create even more cash flows, right? Return that to token holders in the future. And I don't think that is being debated today more enough. Token holders just want, hey, I just want my projects to, you know, spend as much of its financial cash flow as possible into buying back the tokens, because I want the price to go up. But you might actually hurt the longer term viability and sustainability of a business.
Yeah, so if we go back a sec, how we got here is that in the very beginning of blockchains, when it was just Bitcoin and other fully decentralized or largely decentralized assets, there was no equity. Equity has no value in Bitcoin. So the only way to participate in the network is to buy tokens to access the network. And then as we have matured, in 2 cycles ago, investors were still investing just into the tokens, not considering the potential value of the equity, because blockchain companies were so far removed from public markets that no companies were going public, there was very little M&A pre-2017. So the way to get liquidity for an investment was only the token. And I think largely the equity was overlooked. Whereas now that there are so mmany tokens and no liquidity in a lot of the lower and middle market, and then as Zhao was saying, if early stage companies to provide value back to their token holders are taking up to, actually in the case of Houdini Swap, which was the company I was referring to beforehand, up to 100% of their revenue going to buy back tokens, then that is putting a damper on the growth. And while you are committed, let's use Hyperliquid or any example, to buy back up to 97% of revenue, unless that is actually hard-coded, there's no guarantee that the business continues to behave like that. So Hyperliquid, I don't think that it's hard-coded. And in theory, they could tomorrow decide that they're going to put in 50% or 20% of the revenue into, or 0% of the revenue into buybacks. In fact, there's probably, I would need to look at the white paper, but a lot of the time there's actually no requirement for the company to even continue to support the token. So Hyperliquid, in theory, could just orphan the token, sell the equity of the business, keep 100% for the founders, return 0% dividends to their token holders. So because I think if you've been an institutional investor into blockchain venture for more than one cycle, you've certainly seen stories like this where the risk of only playing on the token side, where there's misaligned incentives with token holders and equity holders, has created challenges. One big trend with blockchain capital markets that we've started to talk about is firstly M&A, private M&A, but also now that public markets globally are starting to be open to both public companies holding tokens as well as public companies acquiring digital asset networks. It further creates a demand and a value for the equity and for the governance of businesses and of tokens. Yeah.
Cool. Thank you. For a family office, it's similar. We see it also as an opportunity to learn from new partners. There is a key clarity, like everyone should know what value they could bring beyond money, right? Okay, cool. Next question. So for Michael, do you believe the virtual assets or digital entity could eventually appear on the cap table as like a venture side or contributors or like portfolios? Is it earning a real equity for virtual work?
So you're asked whether if a company holds digital assets on their balance sheets?
Yeah, or some like contributors earn real equity for their virtual week because it's a lot of token holders.
You mean if a company that holds digital assets on their balance sheet, if that should be treated as an asset?
Yeah.
Totally. So now that the valuation of businesses is starting to become a lot more thoughtful with blockchains, and as I was talking about, I totally agree. 2017, the way to value a digital asset network was how big can this be? And as soon as it came to market, and it was not that big, it was actually it was a bearish signal for them to actually have a product with no users, which of course has created scars for buyers of those networks. But now that there is analytic dashboards, I like Dune Analytics. I haven't used Blockworks, but yeah, you can see on-chain, fully verifiable on-chain revenue, user engagement analytics. So it's starting to treat digital asset networks as proper, sophisticated businesses where you can put revenue multiples or value of the user. You can put real valuation analyses to work. And because the venture capital market is pretty dry and public digital assets are oftentimes down 90% from their listing with no vesting and with traded assets, a lot of the capital that does exist in ventures flowing to the public market because the public market is down 90% and the private market valuations have not adjusted properly. So I think that a big part of startups figuring out how to attract capital now is in the building relationships or understanding how equity capital markets works, how M&A works, how public markets works, and how different parts of the capital market work to be able to create compelling stories to bring in equity investors and or M&A opportunities or public market exits. I think one of the best ways to tell a story for an early stage business with digital assets on their balance sheet is that they have assets on their balance sheet that there is a story around.
Mm-hmm.
Yeah, I think there's like two big trends, right? One, I think generally crypto is growing up, right? Like from the biggest new projects a few years ago were all infrastructure. It was all about like just block space and what you can maybe do around the block spaces to create potential applications in the future. Now it's all about distribution, right? It's distribution as a barbell. It's either massive consumer, distribution, and that's like the Jupiters, Uniswaps of the world, like actually allowing retail to do stuff on chain at scale. And then you have ultra institutional, like the Aves of the world and RWA applications. So the infrastructure has matured to a space where like applications at scale can actually serve markets and clients. And what that means is that the newer companies that are built on top of the infrastructure that is already there, they have to be valued in a different way. But the price discovery, I think, is still happening, right? And you have this, of course, on a legal perspective, you have a very interesting discussion about like, are cryptos, like which of the cryptos that we all hold are securities and which are not, right? You could like very simplicity make the argument that some of the infrastructure, like blockchain Ethereum, that's more commodities, want to be treated like commodities. But you have other infrastructure like Solana and some of the other, there is economic value being created on that. And so it's a little bit more blurry whether it's commodity or actually security. But then some of the cash flow generating companies building on top of Solana or Base, right? It looks a lot more like securities if you just have a very clear link to kind of revenues, right? Which can also bring its own complications. And so I think that's sort of one big trend that is definitely happening. The other thing around the digital asset on balance sheet, I think what DATs, we can have very different opinions about DATs, right? And the role they're playing and whether it's good investment or not. But one thing that for sure has proven out into the minds of institutional investors is that digital assets starting from Bitcoin obviously being the most widely credible digital asset, is now really being treated as an effective treasury tool, right? Because it hedges against inflation, it hedges against some other sort of currency risk, and some of the companies which have done very effective treasury strategies around Bitcoin and some others around Ethereum, it's actually, I think, a much more credible and a more sort of widely recognizable way to kind of run your treasury organization. And I think that the implications of that is not fully played out, right? You have now the pure play digital asset treasury companies who basically have no cash flows. They don't do anything else and accumulating just, they raise money and then accumulate digital assets on the balance sheet. But then I think the more interesting bit is like more the Tesla route or like Square, right? Like actually, companies that have nothing to do with crypto, maybe only a little bit to do with crypto in their core business, but actually using their cash flows to buy using some of their cash flows and treasuries to actually buy digital assets. I think that could ultimately be the bigger legacy of this revolution around digital assets, because a much wider set of companies could use even a small percentage of their treasuries into digital assets. That could be a very big sort of movement in markets.
For sure. Couple quick points before we move on. So with DATs, I think just holding crypto on a balance sheet, especially on public markets, is going to get old real quick, super commoditized. I think that they're going to have to, if they want to survive, find ways to cash flow their treasury and to effectively turn their treasury into a modern financial institution, either become a private bank or become an investment bank or become find ways to generate cash flows using the treasury. And then with regards to in 2017, all infrastructure that that was exciting because infrastructure was not, there needed to be infrastructure created, and actually the development as well was a lot more difficult. 10 years ago, there was a lot fewer software developers, there was a lot less understanding of security and stuff. Now infrastructure, I would say, is commoditized. The only thing that is not is what is the narrative? What do you do with that infrastructure? How do you get adoption of it? So, yep.
Yeah, I totally agree. I think 4 minutes left. Last question. So, looking ahead, what does an ideal capital look like? If you could fix one thing about fundraising in this hybrid world, what would it be?
Yeah, I think there's so many things that still need to be for. I think we're still, like, you can debate about the fact whether do we still have 4-year cycles in crypto or not. I mean, you definitely have these cycles historically where in crypto bull markets, it makes a lot more sense to kind of just raise and distribute and exit in tokens, because it brings unique advantages in bootstrapping a company, getting sort of your customers, basically turning your customers into your best promoters, and then much faster liquidity events, right? These are unique things that token markets do very well if the market supports those kind of things, but it's very, very bad if the liquidity is just not there and it's like a deep bear market. It can also work against you, right? It's a double-edged sword. Equity, on the other hand side, is probably better suited for, longer term, more traditional sort of value accrual. You just treat the shares of your company as the securities, and all value that's been created, goes to the equity holders. I don't think it's fully played out, these hybrid structures, what are best practices there. I think it very much depends on what type of company or protocol it is. Is this more infrastructure? Is it really about revenue generation, or this is sort of just about the community and the brand? I don't think there's like a correct answer today. I do think that crypto founders will have to think longer and harder about whether they want to just have token as their main exit mechanisms. I think with the ascent of, because some of the best IPOs this year, as you can see, right, in traditional IPO, have been crypto companies, right? Circle, a lot of the exchanges, Bullish, Gemini, etc. Kraken is coming, and in those sort of equity markets, you actually don't have thousands or even tens of thousands of projects being listed. So there's a relative scarcity, right, of good assets on the equity markets that public investors can buy into. I think it might change in a few years, but that's, I think, a relatively interesting sort of window. Whereas on the token markets, you just have like tens, if not hundreds of thousands of projects now. Still a huge market, 4 trillion, right? Most of that is Bitcoin, but it's still a big market. It will grow, but I just think that there is currently like an imbalance between supply and demand. There's like too many new projects essentially getting listed. And as a founder, I would actually really think about, like, am I trying to build like a leading company in a new market, and I believe this market can grow bigger and I can really capture a share of the financial value being created in the market, then I would really also consider like equity structures where value accrues to them. And then it just opens up different exit opportunities, right? There's more M&A, right, opportunities if your like main accrual is in equity. IPO is to be considered, obviously would be a great exit. But I look forward to new forms, how token models can basically complement, right, equity models. I think it would be very interesting to see how this space evolves.
I think what would be nice to see, to share a bit of a different perspective, is clearly defined relationships that are publicly auditable, as in like viewable by retail, not just by institutional investors, of the relationship between tokens and ownership and revenue and how that comes into play. The problem with that, as we've talked about a little bit, is that a company might intend to do something for a period of time, like have up to 97% of their revenue allocated to buybacks, like Hyperliquid, but then might have a black swan event that to continue to put 97% of their revenue into buybacks might actually put the business out of business. So how do you deal with changes is something that would be nice to have a solution for as an industry. And the second is that having buybacks in general, we've spoken about the challenges and opportunities about this a little bit, but as soon as you have buybacks, that makes it a security-ish, which causes its own problems. So having, and this is being solved now actively, but there being a bridge between blockchain exchanges and security exchanges, ideally have interoperable rails, ideally have the ability for digital assets to have liquidity opportunities on public markets, public securities markets, which I think as that continues to bridge, I expect there to be an enormous amount of consolidation of exchanges and of liquidity, which solves the challenges of liquidity, and yeah, hopefully
Great, very
need to evolve.
informative. Yeah, for me, it's less noise, more purpose. I think the more capital inflow to the founders who are really building the real use case, also not narratives, more like impacts. So thank you for joining us. Thank you for the panelists.
Thank you.
Yeah, see you.